Ladies and gentlemen, it's a great pleasure having you here for our advisory board meeting with our very, very special guest, Russell Napier. Russell, thanks for taking the time.
Ronnie, thanks very much. It's great to be here.
And also here with me is my dear friend, Niko Jilch. Niko, the last time we spoke to Russell for our 2021 in Gold We Trust report, actually you were still with Agenda Austria, the think tank, and now you're running your own business as well, doing a very successful podcast.
Good morning. I can say good morning, even though we don't know when people are going to listen to this. Hi, Russell. Hi, Ronnie. Thanks for having me. Yeah, I'm a freelance journalist slash one person a media business now, and I'm running a German and an English podcast, and I'm happy to be here because yeah, we did have a very, very interesting discussion. Many things that we talked about, Russell, 2 years ago have come to fruition, unfortunately, I have to say, and I'm looking forward to what you have to say today.
Well, Niko, here's to the power of one.
So
thank you.
I will briefly introduce Russell. I think most of you already know him, obviously. Russell is an acclaimed financial historian and a market strategist. He writes the Solid Ground newsletter where we are subscribers, and it's highly, highly recommended, in which he shares his global macro thinking with the readership of mainly professional investors. He's also the co-founder and keeper of the Library of Mistakes, a library and reading room devoted to the study of financial history and associated mishaps. He's the host of the library's podcast too, and Russell is also the author of 2 big books, The Anatomy of a Bear Market, a fascinating study of 4 bear markets, and more recently, The Asian Financial Crisis, the birth of the age of debt. He also runs a very, very interesting course regarding the financial markets history. Mark and I, we attended this course, which was pretty interesting because it was in London exactly that week when the UK gilt market basically broke down. So it was really interesting to talk to mostly British fund managers during that very, very turbulent week. So Russell, thanks again for taking the time. We've got many, many topics to cover. As Niko said before, you've been basically spot on with your very, very big forecasts. I mean, I think your biggest shift was actually from being a deflationist for almost a couple of decades to becoming an inflationist and basically saying that the great moderation is over and that we should expect higher inflation rates and more inflation volatility. So this has been a brilliant, brilliant call. And the second big call probably was the fact that you expected that fiscal stimulus will become much more important than monetary policy and monetary stimulus, which also happened over the last couple of years. So Russell, I mean, everybody wants to know what are your next big calls and how do you see, first of all, those major market calls developing? Do you still stick with them, or would you say, well, inflation is over for now, fiscal stimulus is over for now, let's get back to the old playbook?
Well, sadly, Ronnie, the things you've just mentioned there are just ingredients. They're not the final cooked, baked product. They're just part of it. And I think that's the problem. I think also people can't see that yet. They don't fully understand yet. But the final cooked baked product is a thing called financial repression. I think most people listening to this will be familiar with what it is, but it's a policy setting necessary to reduce the excessively high debt to GDP level of the developed world. And the other thing that's happened since we spoke in 2020, I think anyway, though I have difficulty persuading people, is ample evidence of this financial repression. So we know what the goal is, to reduce the debt to GDP ratio. So how does it manifest itself? Well, I can talk about that, Ronnie, for about 3 hours, but the essential issue is this: the governments take control increasingly of A, the banking system, which is the wellspring of money creation, and B, the saving system, which is a necessary thing for them to control, to depress the rate of interest along the yield curve in a period of high inflation. High inflation, which they rather successfully generated, is not in and of itself sufficient if market-determined rates were to go too high. So my forecast is not just that inflation will remain sticky, though come down, that it is part of a now more evident and growing, clearly growing evidence of a financial repression. This all comes in bits and pieces. It's the nature of government reaction. But let me just quote from the British Chancellor of the Exchequer, who said less than a week ago that ultimately he would not be against forcing British pension funds to buy certain assets. Now, the British Chancellor is supposed to be right of centre, not left of centre, but he didn't. He said he wasn't that comfortable with it, but he wouldn't be against it. And for all those calls, Ronnie, about inflation and fiscal policy, ultimately, neither of those will be as important as this if we are back in the business, as I suspect Switzerland now is as well. Another great shock since we last spoke. In the business of controlling and corralling the balance sheets of banks and the savings of the people to generate and help with inflating away their debts.
Niko?
Really quickly, because as we speak, we've just had another bank failure in the US. Do you see any connection with this? Are the regulators going to use these bank failures to introduce new rules for the banks to make them safer? But because some of the problems did come from holding too much government paper.
Yes, they are. They are going to find other things that will make them safe. It is interesting that as governments rush around trying to make things safe, they don't always succeed in the goal. The argument is not that they make things safe, it's that they direct the flow of credit. What the government has done, FDIC, but ultimately the American government, and of course we do have to keep also referring to the Swiss government here, what they've ultimately done is guaranteed all the deposit liabilities of the banking system. That's the crucial feature of these collapses. I think four that I can think of. None of the large-scale depositors have lost any money. Now, whether the actual bondholders lose any money, I guess time will tell, but Janet Yellen has slightly flip-flopped on whether the system is now backing large-scale deposits, but I think everybody thinks they are, and Warren Buffett has said that they are. Now, a government that backs the liabilities of a banking system is ultimately on the hook for its assets. And the Irish government tried this in September, 30th September 2008, a day in Irish history that will live in infamy. And they ended up with government debt to GDP blowing out as they had to pour more and more money into the banking system to meet these guarantees. The governments know this. They've been here once before. So what we'll see now is them getting more actively involved in the asset side of the balance sheet. There's a price to pay, and the price to pay is that. And it's already evident. It's been evident, particularly in Europe post-COVID. It was evident everywhere during COVID. And that's the price. Now, there are different ways of doing this. And one of them is providing guarantees on bank lending. But I mean, the Inflation Reduction Act is actually another way of doing it, Niko. You create so many good incentives and cash flows in certain private sector companies that the banks are, let's say, encouraged to lend to them. So the crucial thing that's happening is the capture of the financial system, not the collapse of the banking system, the capture of the financial system to do the public good as the public needs in a time of serial emergency. And that is why equities are going up and not coming down, because this is not a rerun of 2008. This is more a rerun of 2020. There's sufficient emergencies in the world that the government can justify not just bailing out the banks, but taking control of the banks and steering bank credit growth. So you get two entirely different views of the world depending on whether you think the banking system's collapsing or the government's taking control of it. And I'm certainly in the latter camp. And it would be quite a shock in America, but my goodness, what a shock it will be in Switzerland when it comes to pass there.
Now, Russell, in one of your most recent interviews, you said that actually most people in financial markets, they still stick to kind of the 2008, 2009 playbook, while actually people forget that in 2020 we had basically the biggest GDP decline, I think you said, since 1707, something like that. But actually, we could also say that they managed it pretty well. We didn't see any major banks going bust. We didn't see any bankruptcy in bigger companies. We didn't really see too much volatility in financial markets. So actually, I agree to that topic. But then on the other hand, if we say that, well, fiscal policies or the governments are basically taking over control, first of all, what then is left as a job for banks and for central banks? And then on the other hand, we all have an opinion on that, yeah, and probably the market couldn't care less about that. But are we still in a kind of a free market liberal economy anymore then?
Yeah, so the 1707 date, that's just relates to the British economy. And as you know, 1707 economic statistics are not entirely trustworthy, but yeah, that initial decline in GDP was supposed to be the biggest decline since 1707. What was the price we paid for the success in managing that? Well, the price we paid is that across the developed world, the banks were forced to lend money into a recession and create money, and that's the important thing. And that's why we have inflation today. So the price we're paying for that form of intervention is inflation today. And that inflation is creating not just economic havoc, but it's creating sort of political, social havoc, some places much more so in the world than others. So there is a price to be paid for this, and we've already seen part of what that price is. What is the role for central bankers? Well, I'm sure everybody listening to this has read Friedman and Schwartz's Monetary History of the United States of America. And if you haven't, it may be worthwhile rereading the period that covers the history of the Fed from 1942 to 1951, because it's quite clear in the pages of Friedman and Schwartz that the role of central bankers in 42 to 51 was really to drink coffee. There was no other role for them. And that is because there was a financial repression. Now, obviously in warfare, it's an extremely strict form of financial repression. It's something I think maybe we're unlikely to see in that form. But Ronnie, you've hit the nail on the head here, because if commercial banks make money and the government can control the size of commercial banks' balance sheets, number one, and if I'm right, we eventually get to the stage where they also do yield curve control, they are controlling both the quantity of money and the price of money. And there isn't anything for central banks to do all day. So I do genuinely think that that is where we're going. And, a lot of people say to me, well, will the central bankers give up? Will they announce that we're not going to have 2% inflation? Well, it'll just become obvious to the market. They do not have the power to deliver these things. These powers are being stripped from them. And that's the path for central banking, not that they fail, if you like, conventionally by just having the wrong policy settings. It's that the tools to deliver are stripped from them. So that's what I think happens to central bankers. Commercial bankers, well, it's just the politicization of credit. I can't even remember, only if I mentioned this book the last time I was here, but it is called Controlling Credit. It's a history of the French banking system post-World War II, written by Eric Monet. And it's a form of monetary policy which I think is completely alien to just about everybody, but one we have to go back and focus on, which is credit controls, which if a government can cap the rate of bank credit growth, it can cap the rate of money supply growth. Now, the problem for bankers is, yes, it's quite nice that they get allocated a certain growth in credit, but the government would want to have a huge role to play in the allocation of credit within, let's say, the limit is 10% growth in bank balance sheets per annum. It's inconceivable that that would be done purely by market forces. So for bankers, commercial bankers, the future is the politicization of their balance sheets to achieve political goals. And those political goals are easily framed in an age of emergencies. I mean, I barely and rarely hear a politician speak that he doesn't use the word emergency after. So we have a climate emergency. We have a hot war. I'm not saying these aren't emergencies, by the way. I'm just saying the word is spreading. A hot war emergency, a cold war emergency, a inflation, cost of living emergency, an inequality emergency. And when the word emergency is right up front and center in political discourse, you should expect emergency finance. And the role of the commercial banker in a period of emergency finance is to provide the finance to end the emergency, full stop. And that is the future for bankers. And back to Niko's question, the more influence and control or safety nets the government provides for these institutions, the more they are ultimately beholden to the governments.
A very quick question. Do you think that the push for central bank digital currencies is a way for central bankers to get some control back from the governments? Do you see a conflict there, or is this part of the governments taking control?
Yeah, so the go-to opinion on this is from August Carstens who runs the BIS, and he wrote a paper on central bank digital currencies, which I think must be early 2021. Which is absolutely worth reading. It's on the BIS website. And he looked at central bank digital currencies, and he came to the following conclusion, that in unlimited size, they are fundamentally dangerous. They would ultimately destroy commercial banks and pass all the power of allocation of credit to the central bank. So let's just think of the mechanism of that. All of us have deposits, and let's say one morning we concluded that the safest deposit in the world was with the central bank, the CBDC, and we decided to move from the commercial banks to the CBDC. So now all the deposits of the world rest with the central bank, and it would be up to the central bank to allocate those. I mean, probably not directly, I'm not suggesting it would be lending, but it would pick which commercial banks would receive the liquidity. And this would be the biggest threat to liberty. I mean, not just economic and financial liberty, but all liberty that we actually have seen since the Second World War. Now, Carstens doesn't quite use the words as dramatically as I've just done, but he does make it very, very clear that the CBDC, in unlimited size, not in a limited amount, but in unlimited size, is fundamentally dangerous. So if the central banks were to go ahead with CBDCs in unlimited size, which they will not do, but if they did, then they would become by far and away the most overmighty citizen in the whole of the country, much more powerful than the state, in my opinion, much more powerful than any private sector institution. So yes, if done in size, this is the central bankers coming in, but they won't do it, and they can't do it. And there's no way the governments will let them do it because of the amount of power that would flow to the central bank on a CBDC. I must tell you a funny story. There is a CBDC in the Bahamas. And I was recently in the Bahamas, and of course, everybody I met, I asked them if they're using the sand dollar, which is the CBDC. And I couldn't find anybody. And believe me, I did ask young people, because obviously old people tend not to. And the reason that they weren't using it is it wasn't really adding any functionality. So I was at dinner one evening, and a gentleman beside me, I asked him, he said, oh yes, I use it all the time. And that surprised me, because he was the first people, but also he was probably about as old as I am. And I said, that's really interesting. He brought it out, he showed me the app. I said, why, I mean, and he told me how he used it. And I said, that's interesting. What do you do for a living? He said, I'm the central bank governor. And then the lady beside me chipped in, and she showed me how she was using it as well. And I said, well, let me guess, are you the wife of the central bank governor? She said, yes. So as a means of transaction, it doesn't really add any functionality. However, as a store of value, it could, particularly in a crisis, become a huge threat to just about everything. So my view, Niko, is the central bankers, Carstens in particular, has warned everybody what the consequences of this are. And it would be like the central bankers going to war on the private system and the government to strip huge amounts of power from a democratic system. I think it's very, very unlikely. I'm not saying there wouldn't be a small CBDC, but one that would be in its size sufficiently large to challenge what you and I have as a store of value in terms of deposits. Not likely. Overmighty citizen, I think, is a good phrase, one we're going to have to get used to more and more. There's only going to be one overmighty. There's only room for one overmighty citizen in a financial repression, and that's the state. It's not the central bank.
I think, just the name sand dollar from the Bahamas, that's probably, you should reserve a spot for that for your for your library of mistakes. But Russell, you mentioned the topic of war, and since we spoke the last time in 2021, we were talking about the Cold War, obviously, but now we do have obviously a hot war between Russia and the Ukraine. Now, Zoltan Poza, Niko and I, we interviewed him last week for this In Gold We Trust report. He wrote a couple of fantastic pieces. You probably read them as well. And he said, first of all, that war means inflation, and you probably agreed to that topic. But then also, I just heard a podcast that you did with our mutual friend Marko Papic at Clock Tower, and then I read a piece that Marko wrote a while ago. It was called "War is Good," and obviously he doesn't refer to the human consequences of a war, but I think he brought up a couple of very interesting topics. First of all, that investors should kind of avoid extrapolating geopolitical disequilibrium into a global conflict, and that those periods of multipolarity that often lasted for decades were often providing also a pretty good backdrop for technological innovation, and this Capex cycle that you're also referring to. So over the short term, war could mean higher inflation, definitely, but over the long term, due to this competition and more innovation coming up, it could also be a disinflationary driver. Now, would you agree to that viewpoint?
So Marko is from the former Yugoslavia, and I'm from Northern Ireland. So we're both very keen that there isn't any war.
Yeah.
As we all are. So I would not agree with Marko on that, and it's because I come from a different place, which is the place of saying, not with 100 degree of certainty, but with a high degree of certainty, that inflation is always and everywhere a monetary phenomenon. So it depends how this is financed. That all the things that Marko's talked about, it depends how it's financed. Now, when I look around at the levels of debt in the system today and the levels of government debt in the system today, I just don't see how this can be financed without more money. I mean, the easy way to finance anything is by creating more money. And we witnessed it now, what, 3 years? For 3 years now, we've witnessed that the governments will take the easy way out on this and finance it with more money. And that is what happens in war as well. Of course, we have great big bond drives running, and that's what a financial repression is. It's a bond drive to get people to buy bonds at interest rates that are actually well below the rate of inflation. And it's also about creating money. So everything that Marko says about the real economy can be true, but you can still have inflation if it's badly financed. And, the first casualty of war is the truth, and the second casualty of war is price stability. And there's a reason for that. And it's not just about a scramble for these scarce resources. It's about how it's financed. And now more than ever, going into other wars, we may have had low government debt to GDPs. But I'm just looking at the British one, by the way. Let me give you some numbers on the British ones. At the end of World War II, the government debt to GDP was 270%. And by 1991, it was 30%. And now it's 106%. Now, simply put, all the nice things that we want and all the things that innovation are going to have to be financed. And I just think they're going to have to be financed. We've had a huge debt supercycle, and they're now going to have to be financed more by money than debt. So that means inflation to me. And it's, I hope, and I think, a Cold War in Asia, not a hot war. Now, let's say I'm wrong on this. It is a truth that we don't like to recognize, that the rejuvenation of Asia post-World War II was partially based on warfare. And that was initially the Korean War, which had a very stimulatory impact on Japan. And then laterally the Vietnam War, which had a very stimulatory impact on Southeast Asia, and Hong Kong was a beneficiary of both of these. So yes, I mean, one can recognize that that's something that a hot war can do. But I think given where we are with debt, I think even a Cold War is going to have to come with high inflation. Never mind if we get to a hot war.
Now, Russell, the Capex cycle, I think that's another topic that you were basically one of the very, very first ones to address. Could you perhaps run us through that idea or that theory that you have that is playing out, which would basically also mean continued outperformance of, let's say, old economy sectors versus the tech space that did so well over the previous cycle, and then I mean, one thing that always comes to my mind, hearing about those cycles. Well, actually, I'm not so certain if governments are really very efficient when it comes to subsidizing everything and getting too much into the business of what usually business owners and investors would do. So doesn't that if that trend is going to continue, and it seems so, won't it leave us with lots of stranded investments, lots of further things that you can probably mention in your library of mistakes, and lots of government-owned companies that are basically an enormous waste of capital?
Yeah, so just in case, for those who are listening, in case they don't know, obviously we've had strong run in tech stocks this year, but I just looked, the Nippon Steel is outperforming Amazon. Right, not by a lot. It's not quite as good as Microsoft, but it's nearly as good as Microsoft. So something is happening, Ronnie, in the world that we need to pay attention to. I mean, too often I speak to investors who have their own view, but are not prepared to look at what the market's telling them. And there are some things changing in these heavy industry stocks that we need to pay attention to. And what is changing is, I mentioned earlier, this age of emergencies. And next time you hear a politician cite an emergency, think to yourself, what's the answer to that emergency? Because I think you'll find it's Capex. Now, some of it's pretty dire Capex already, and completely non-productive Capex is easy to spot. It's called defense. Okay, so, it's just, it's Capex aimed to destroy rather than Capex aimed to facilitate. So we know that's going to happen. We know that is happening. And we know that's going to happen big scale because it's happening in Asia. It's not just about Russia. It's in Asia. One of the things that we're witnessing now is NATO, the North Atlantic Treaty Organization, being somewhat interested in the Pacific as well. So this is important in terms of defense spending, et cetera, et cetera. But all of these, whether it is the biggest thing is if we genuinely get to a Cold War with China, we are going to need to produce all the stuff we currently buy from China. That's a huge capital expenditure boom. Labor markets are tight, depending on where you are in the market, in the world, very tight. That's also a huge Capex boom as we go forward. We're going to need more robotics to cope with this, more automation to cope with this. So the reason that I come to the drive for a capital expenditure boom is that is really, as far as I can see, the only answer to the political problems. My view is that, as you say, Ronnie, they don't just use their own money to finance this. They use the banking system to finance this. And there's no better example of that than the United Kingdom again, where the Chancellor of the Exchequer is getting involved with our savings system and is compelling them, or trying to compel them, to invest in certain types of things that the government wants financing. So that is coming. Now, to your second point, will there be misinvestment? Yes. It takes a while, though. And it particularly takes a while if we're in a Cold War with China. So if I said to you, Europe, steel industry, how many years of building capacity would we need before we overinvest? You might know the steel industry better than I do, but I think it's a lot. I think it's a lot. So what we've had in the past is sometimes government have intervened in market systems at various times of full capacity, short capacity, and then their intervention is visible quite quickly. But in this particular occasion, because the reason for doing it is probably we're in a full-blown Cold War with China, it might take a bit longer to get there. But let's remember where the United Kingdom got to in the 1970s. We were spending all our money investing in coal, British Leyland, and Concord. Now, none of these proved to be fine long-term investments. They all proved to be misallocations of capital. So you do get there in the end. Of course, you get there in the end. But in the industries specifically that we've been referring to, which are maybe more old economy stocks, it will take a very long time. And this relates to a form of investing that's called the capital cycle, which, as you know, Ronnie, we teach in the course. Edward Chancellor lectures for us on the capital cycle. And I just think we've underinvested for so long that it would take a long time to distort this. And one final point, in Andrew Smithers' book, which is called, I think it's called The Productivity. It's his last book about productivity. The name of it, The Productivity and the Bonus Culture. He's got some wonderful, really long-term charts of US corporate investment in tangible assets as a percentage of GDP. And really, we've just never seen it so low. And without going into all the arguments for that, it isn't going to stay low. It's going to go up. And that is the opportunity for investors to align their interests with these particular corporations that deliver on this, while recognizing in the very long run that a government subsidized price of capital will distort the capital cycle at some stage. But this is a gift horse not to be looked in the mouth.
Where does this lead us? You gave this extremely fascinating interview with a Neue Zürcher Zeitung. And I think you talked about 20 years of this, 20 years of the government basically steering industry, steering the banking system, inflation, financial repression. And then you have this very interesting theory that at some point, you know, it's I think, maybe tell me if I'm wrong, at some point, you know, things get so bad from government malinvestment that things just come to a halt, and we go back to you know, people wanting more, so quote unquote free markets. So you compared this with Thatcher and Reagan. Is this what you think, that we have like 20 years in the West, at least 20 years of government intervention, dirigismus? Don't know what the English word is. It's the French thing, right?
Yeah.
And then we go into actual stagflation and go back to some sort of free market thinking.
Yeah, absolutely. So the reason for saying 20 years, and I really don't know whether it's 20 years, but I'll explain why it's more than 10, is if the ultimate aim is to get the debt to GDP ratio to a sustainable level, then we have to, as it was the last time, then we have to look at what that sustainable level is and where we are today. Now, without going into too many details, it does seem to be sustainable. If total non-financial debt to GDP is around 200%, that seems to be sustainable. And a country like Germany quite well copes with that level. And sometimes German debt to GDP comes down in an expansion. Sometimes it goes up in a contraction, but it's not out of control. So I would say we're aiming for something closer to 200%. Last time, by the way, we aimed for a number well below 200%. And last time being 1945 to 1980, roughly. Where do we start? Well, it's coming down rapidly already. It's a point that people don't like to talk about because we dwell more on the problems of inflation. But debt to GDP is coming down quickly because the price of debt instruments are falling, but more importantly, the price of nominal GDP is going up. But even so, we are looking in the developed world at roughly 270% of GDP. And there are some outliers in there. The obvious outlier is Japan at 415% of GDP, but the outlier that dare not speak its name is France at 371% of GDP. So, Niko, the reason for taking a rather long-term view on this is because if we've got to get from up there down closer to 200%, that takes quite a long time of nominal GDP growth outstripping the growth in debt. And maybe it's only 10 years, maybe it's 20 years, but it's a long-term project which we have embarked upon here. Now, the pace is difficult. If we go back to the end of World War II, the United Kingdom and France had not dissimilar levels of debt to GDP. Now, France was able to, basically not honor some of that debt for the very good reason that it had been imposed upon it and is what we would call in legal terms odious debt. But the real reason that France managed to get rid of its debt after World War II is that it went through a 4 to 5 year period where interest rates were close to 6 and nominal GDP was growing at 50. I stress nominal. And that's a good way to do it. That gets you there pretty quickly. It didn't take France 15 to 20 years to reduce its government debt to GDP ratio. Now, the United Kingdom achieved roughly the same thing in reducing its debt burdens, but it took it from 1945 to 1979 because it was less aggressive at destroying the wealth of its savers than was France. And there are good reasons for that. I mean, if you had a lot of money left in France at the end of 1945, people were suspicious as to why you had that money. That wasn't the case in the United Kingdom. There were more reasons why in France it was perfectly acceptable to destroy the wealth of bondholders than there were in the United Kingdom. So one country did it rather aggressively, and the other country did it slightly more gentlemanly, but ultimately to the same end and the same effect. And that's the question we have to ask, Niko. I mean, it could all happen very quickly if we find developed world governments prepared to take that route. I think we won't. I mean, I think the potential political instability associated with going route one and getting this all done within 3 to 5 years is too high. And certainly in the developed world, we wouldn't contemplate it. We don't have the great hatred of bondholders that had perhaps developed by the end of World War II. So that's why I come up with this longer term period. But as you can tell from that analogy, it really is a political choice. Each politician is going to have to decide how quickly they want to do this. So it's not hyperinflation that does it, as France did after World War II. It's financial repression. And my simple definition of financial repression has long been stealing money from old people slowly. And that's why I think it takes, certainly more than 10 years. But I don't rule out that some country might go route one. But I don't think it's a developed world country that would do that. But I guess political pressure will tell, and we'll see who will go route one. But I don't think we'll look at that in the developed world.
And obviously, there's lots of older people to steal money from due to our demographics. Russell, I wanted to segue this conversation a little bit into the direction of the current setup that we're seeing in financial markets. Now, the leitmotif of this year's In Gold We Trust report is showdown, because we're seeing some sort of a showdown when it comes to the geopolitical area with the BRICS nations and the SCO nations becoming much more louder and kind of more vocal to question the status of the US dollar. So this de-dollarization topic, this is something that we're writing about for quite a while, but now it seems that it's really becoming more of a mainstream topic. We've seen it on Fox. I think the FT was writing about de-dollarization, stuff like that. And I think that it is a process, and it will continue to take a couple of years. Michael Chamberlain, the JP Morgan, put out a great paper. He said it's going to take like 20 years because we shouldn't forget the Chinese also have major problems. So it would be naive to think that very soon from now the whole. And I think he was mostly referring to not the status as a trade currency, but rather of a reserve currency. I think that's very important to differentiate. And the second major showdown that we're seeing in markets is obviously between the Federal Reserve and the economy and financial markets. So I think that actually, like 1 year ago, nobody would have expected. I don't know any market strategist or analyst or astrologist who would have said, well, actually, they will raise interest rates by 500 basis points, and the S&P will still be trading pretty well, and the economy is not in a major recession or depression. But still, we know that the Federal Reserve and central banks in general are always way behind the curve. So would you say that this recession, that the yield curve, but also the ISM, the leading economic indicator, and so many other indicators that are forward-looking, that this recession will happen over the next couple of months? Or do you really think that the forces of fiscal stimulus are so strong to completely take those recessionary forces out?
Yeah, so there's two subjects there. The first one is a huge subject, which is the dollar as reserve currency. I mean, absolutely huge. But I think you made the distinction which people need to think about more, and they don't, and it confuses the issue, which is Saudi Arabia may transact with China in renminbi, but will it hold them?
Yeah.
There is an upside for the Chinese in just merely transacting in it, because it's beyond the long arm of America. So the Chinese like it if the transaction takes place. But will Saudi hold them? Well, the evidence we have to date, there are two pieces of evidence that I look at. One is the composition of foreign exchange reserves, which we get every quarter. There's no evidence that the RMB is being held as reserve currency. It's held by one central bank in large size, and that is Russia. And otherwise, it's tiny. It's absolutely tiny. And from memory, I think it was 2014 that the Chinese first opened up the Chinese bond market to reserve managers. And basically, it couldn't really form part of reserves until there was a big liquid market for you to put it into, and that was the Chinese bond market. And since then, there's been virtually nothing has happened. So we have to say, look, the ability of reserve managers to own this thing has been around for a long time. The amount of trade they do with China has been high and going up, and they still haven't owned it. So has something fundamentally changed in the world that would make them own it? Well, if you're an enemy of the American bloc, perhaps, the interference with Russia's reserve assets maybe, but the evidence is not, it's going down. And that is actually because Mr. Putin's having to sell some of his reserves. So these transactions, yes, but ownership, no. And it's ownership that counts. It is ownership that absolutely counts for the US dollar. The thing that makes the US dollar strong is not that we transact in it. It's that we own it as reserve managers and in the private sector. And then we have some data on the private sector. So China, like other countries, publishes a net international investment position. And they reveal in that, as every country does, the value of domestic portfolio assets held by foreigners. So that is the willingness, and also non-liquid assets. It's the willingness of foreign or private sector to own RMB denominated assets. It's coming down. It's not going up. Now, it rushed up over 6 years as we included Chinese bonds in the various global bond indices, but now it's coming down. So at least for the last couple of years, and things can change, the evidence is not that people want to hold more RMB, but they want to hold less RMB. Now, which currency have we worked out that they want to hold more of over the last 2 years? Probably the one they want to pay a higher price for. Now, what's the one they want to pay a higher price for? It's actually the dollar. So, this could be a long answer, Ronnie, because it's a huge subject. But let's go back to Switzerland. In the period after World War II, if you wanted to seek to avoid the process of stealing money from old people slowly, you put your money in Switzerland. Now, some of that obviously was to do with secrecy, but actually a lot of it was to do with the fact that Switzerland could be trusted to uphold the rule of law. It didn't have a lot of debt, so it didn't need to inflate away debt. So there were two things here: the sanctity of contract and a government balance sheet which did not require the alleviation of inflation. Is that true of Switzerland today? Because Switzerland's just intervened and completely overruled private sector contract law. And the government has a contingent liability, not yet triggered, that is hundreds of times bigger than GDP, given its role in the banking system. We could debate the extent of the guarantees in Switzerland, but I think they're pretty extreme. So where do you go with your money? And I think more of it goes to America. Let me just keep going on this, and then we'll come back to the other question. And then we have this incredible speech by Christine Lagarde 2 weeks ago, which everybody needs to read. It is just incredible. And as with most of her speeches, it's hard to believe that she used to be a lawyer, actually, because she speaks with such imprecision these days that she must have sat at the feet of Alan Greenspan to speak with such imprecision. But the speech, vague though it is, raises these huge questions, but it obviously focuses on the role of central bankers in a world dividing into two systems. And I think what is in there is really a concern about the euro as a reserve currency. It is the second reserve currency. And if one bloc, and I think it will by far and away the biggest and dominant bloc, coagulates more around the dollar, maybe we get more holding of dollars and few holders of euros. At least that's one of the things that her speech provoked in my mind. So as you say, the decline of these things happens a long time. There is a wonderful book by Catherine Schenck called The Decline of Sterling, which I'm just looking at on my shelf. And the decline of sterling as reserve currency took a long time, even though the country was bankrupt in 1945. Even then it took a long time for this to happen. So I'm not in the de-dollarization camp. I can see there'll be some bad headlines around that, particularly in relation to Saudi Arabia, and there could be days, weeks, and months where it has an effect on the dollar exchange rate. But I don't think that's a world that we're living in. I'm in the other camp. So that's only a partial answer still to the first question, but that would be my pushback on de-dollarization. Mm-hmm. In terms of the second one, it's really not whether there's going to be a recession, it's what sort of recession it's going to be. Now, for my clients, I've looked at all the recessions since World War II, and they kind of divide into two camps, which is kind of every recession up until 1990, and then every recession past. And the recessions from 45 to 90 all came replete with inflation. Now, inflation came down in all these recessions, but there was no prospect of deflation. Genuinely, as a young investor in 1989, all the way up until the early 2000s, nobody conceived that the threat of deflation could come in a recession. It was thought to be, actually, I heard the word used, impossible in a fiat currency system. And then, of course, we had a series of recessions where we had it or the risk of it. And it came with massive defaults, massive write-down in bank assets, significant write-down in corporate assets. And suddenly we had an entirely different type of business cycle. And it was a business cycle where corporate earnings regularly halved Now, that was with the addition of some fairly creative accountancy in terms of swinging impaired assets or cheaper assets through the P&L. But I think what we're looking at now is a return to those 1945 to 1990 recessions, because as we saw in 2020, credit continues to flow through the recession. And that's fundamentally the difference between a recession that could become a depression and, if you like, an ordinary recession. And these interventions in the banking system are absolutely key. Because remember, we're not looking at a world where, I mean, I look at Republic, as far as we're aware, people are still paying interest and principal on the loans to Republic. Now, the Republic badly priced their assets, and that's been the issue. Mm-hmm. But they're not impaired assets. Unemployment isn't going up. Outside of California, we're not looking at a collapse in residential property prices. And yet the government is in instantly to back these banks, and instantly, I think, to keep credit flowing. And for what it's worth, the data over the last few weeks shows that bank credit growth is still expanding. So in that world, it's a different form of recession. It's one that comes with not a collapse in corporate earnings. It's one that comes with higher inflation. And in my opinion, it's the form of recession, given what's already happened to the decline in the price of equity since it would have been in the third, fourth quarter of 2021, that's why the market's going up. It's beginning to realize that this is a recession where we are socializing risk, where we are taking more risk onto the public balance sheet, and that's good for private sector assets. So yes, it's a recession, but we have to remember why we constantly talk about recessions and over a recession and talk about recession and recession. And what about the recession? It's not the recession that counts. It's what happened to corporate earnings that counts. And let's recognize that not all recessions are the same. So we all suffer from availability bias. And the availability bias of most people is the last recession, the recession before, maybe even the recession before that. And that availability bias, as soon as you think of the word recession, you think of bank collapse, property price collapse, credit being pulled back, deflation. And of course, that's a possibility. Of course, I could be wrong. But it is now, to me, much more likely, given the scale of intervention in this system, fiscal, but also monetary, the government's backing that system, that we return to recessions that are more like the 1945 to 1990 recession. By the way, the average decline in EPS in those recessions was 11%. That's right, 11%. Quite a big range, obviously, but average of 11%. I would say that this market by last September had discounted that form of decline in corporate earnings. There are lots of interesting things going to happen in this recession, but I mean, and this will sound peculiar, but I'm really interested to see what accountants will do. Can accountants really mark down the value of assets in this recession in an inflation when the value of these assets are so clearly going up? And if they don't, what does it mean for corporate earnings? Because in the past, that's played a huge role, because we can see if you line up the decline in S&P 500 earnings against the decline in national income product account corporate earnings, it's a different set, but it's completely different. And the reason they're completely different is because of the accountants' ability, willingness to swing write-offs through the P&L. So I think that will come down. And if only for that, the earnings decline in this recession will be more muted than the past. So yeah, there's a recession coming, but I don't think there's a huge earnings collapse coming. And therefore, equities are, as we discussed earlier, there's some sort of equities are doing really well in this politicized system, but equities generally are better than bonds in this environment. We might come back to bonds because they face more than the challenge of just, a sticky inflation.
Russell, let me ask you. You talked about financial repression and the arguments or the comparisons that you make is to a time like decades ago, right? When governments did have better control over their population. We now have a digital world. So my question is, do you see this working in the digital world? I mean, when we look at AI, what's happening there, we don't even know what's going to happen in 3 weeks, right? And aren't people able to escape financial repression better than before? And yes, this is also the Bitcoin question.
So in many ways, it's easier to impose a financial repression than it was before. So let's go back to the period after World War II. And what has been one of the dominant trends of that entire period, where it has been that savings have migrated from private ownership in the name of the individual into an institution. If we go back now, I'm doing this from memory, but roughly at the end of World War II, I think 65% of the UK stock market the shares were registered in the names of individuals. Today, I think 10%, 90% of it is registered in the name of institutions. And of those institutions, the vast majority will be regulated. Not all of them. Private family offices aren't, sovereign wealth funds aren't, hedge funds aren't, but the vast majority of those institutions are regulated. So what has happened over this long period is that more and more of the savings of the people are inside regulated financial institutions. And it is obviously much easier to run a financial repression if you're already regulating those savings. So, I'm not saying that it's all gone one way. You've pointed out that some things have gone the other way, but let's not forget that some things have gone in different directions. So if you can regulate that vast bulk, maybe you wouldn't even have to regulate the other bit. Maybe if you could repress that bit, it's so big that you wouldn't really have to bother repressing the other bit. Perhaps, let's see. And then there's the evidence. Obviously, capital controls, which is part of financial repression, which is the bit I think that most people say, well, in a digital world, it's so easy to avoid capital controls. Well, ask the people of Iceland. No, I think it's pretty obvious that some very wealthy people in Iceland were successfully dodging capital controls. But ultimately, most people didn't get to do that. Ask the people of Greece and of Cyprus. And I mentioned these three countries because these are developed world countries. At least they were developed world countries. I think Greece has slipped out of that characterization now. And then, of course, there's China. Now, we know that the Chinese capital controls don't work perfectly, but they work somewhat. So that's the first thing I'd say is that, we have a system. We have A, much wealth regulated, B, evidence that these things work, if imperfectly. And then, of course, the final thing is that we are talking about the very survival of the state and democracy here, in my opinion, at a level of interest rates that properly reflect inflation expectations. The state's bust. That is where we were in the summer of 2012. The inability of Italy, which I think is the 5th biggest bond market in the world, and Spain, which I think is the 9th biggest bond market in the world, the inability of those states to issue debt at a price that they could afford had come to an end. And what happened then? Well, what happened then is Mario Draghi said, whatever it takes. The United States in 1932 was, on the verge of collapse. So what happened is we abandoned the gold standard. The point is that the inconceivable is absolutely conceivable when the survivability of the state is threatened. And therefore, closing down all loopholes that would allow anybody to avoid a financial repression is the easiest thing in the world. So in terms of cryptos, there are 3 cryptos. We've discussed one, which is CBDC. That just leaves the other 2, which is a stable coin and also private sector currencies. And a properly regulated stable coin, of course, is no route for avoiding financial repression, because what is it backed? What is it backed by? It's backed by short-term government debt. So that just leaves the private sector crypto. So if the private sector crypto becomes a portal through which people can avoid financial repression, then they'll have to stop it. And it's as simple as that. It will have to be stopped. And that is the history of financial repression. If you look at any country that brings it in, they then spend the next 30 years bringing in regulations to stop the arbitrage, which you and I as savers try to escape the repression. And they chase us around like a giant game of whack-a-mole. So if the private sector crypto becomes a portal through which we avoid financial repression, something will be done about it.
Now, Russell, we cannot have a conversation with you and not talk about gold, at least for a couple of minutes. You mentioned a speech by Christine Lagarde, and I thought it was pretty interesting that she was referring to the fact that that countries like China and Russia are now, buying gold to kind of diversify and circumvent, all those repressions and sanctions that are being established since the beginning of the war. First of all, do you think, what's your take on the price of gold at the moment? I can already mention that we are quite confident because gold has made new all-time highs in basically every currency, or let's say every currency has made new all-time lows in purchasing power measured in gold over the last couple of months, but in US dollar terms. And still the whole world is mostly staring at the dollar price of gold. And I think we will make new all-time highs in dollar terms this year, and this will lead to some sort of, also Western financial market investors really starting to buy more gold again. Because if you have a look at ETF demand, for example, you can see that, well, actually for the last couple of quarters, we haven't seen any major inflows. And I think that Western financial investors are some sort of the marginal buyer when it comes to gold. But the second question is, do you think that gold could be framed as something like, that mostly, dictators and countries like Russia and China as kind of the enemies use, and that this could be some sort of a new narrative, like it was used, for example, for Bitcoin, which started out as some sort of libertarian money, and then, the narrative was it is only being used for, kind of strange transactions on the Silk Road and stuff like that, and to finance terrorism. Do you think something like that could happen to gold as well?
Yeah, so on the price of gold, I am very optimistic. One of all the things that I've forecasted came true. I mean, the thing that still shocks me is inflation expectations. I mean, it's still quite shocking that, one almost doesn't believe it when one looks at it, that they're still anchored. I think let's use the word anchored. Central bankers' favorite phrase. I'm not really sure why they're anchored, Ronnie. I can't really understand it, but they are anchored. So the upside for gold is if we ever unanchor that. And, the basis of our conversation over the last hour is really how they are going to become unanchored. So there's plenty of room for upside in gold just because of that. And then secondly, if we really are getting into this repression where the government is able to steer your savings to where they want them to be, gold is a little portal, back to Niko's question here, gold is a little portal where it is somewhere else, and there are extreme situations in which you can do things about that, as Roosevelt did in 1933, but frankly, it's so small and there's so much low-hanging fruit to be taken out of the regulated system. I don't think the government comes after gold anytime soon. So gold is a beneficiary of the financial repression, not just the inflation, but of the financial repression to come. The last point is a fascinating question. I mean, really, really interesting. If I wanted to attack gold, Ronnie, I wouldn't go the route, hey, it's only used by crooks and dictators. Though now that you raise it, probably that's something that will be brought up. But there's another thing you can say. It's killing the planet. So I was in London most of last week, and every single day, Just Stop Oil protesters walked incredibly slowly through London, bringing the whole city to a halt. Now, we all know that we need oil, and, it'd be nice to get to the stage where we don't, and, there's a hell of a lot of money being spent on doing that. But we need it. It's going to be argued that we don't need gold. Why create all these emissions in extraction and smelting to create a bar of shiny things that goes back into a hole in the ground? Now, you can see, only that this is not necessarily my own argument, but this, I think, is an argument that will come. So I wonder if the time will come. Now, admittedly, it's a very small percentage of the world's emissions, but in a politicized system, in a system where the government gets involved in funding the things it wants to fund. Look, and central bankers are doing that. The Lagarde portfolio is trying to skew away from all corporate bonds to corporate bonds that meet certain green agendas. This is the new normal. Why wouldn't gold be demonized for being a thing that is non-productive, which is, as you know, an allegation that's been raised against gold since the first piece of gold came out of the ground. It's an unproductive, but still produces CO2. Now, think about what the consequences of that are, actually. They're very bullish for the price of gold above the ground, or sorry, that is already smelted, because most of it's smelted and goes straight back under the ground. But obviously would cause lots of problems for miners. In other words, we'd be restricting the supply of gold if we get to the stage, like oil, where we say your cost of capital has to be much higher. That's what we're saying to oil. We're enforcing a higher cost of capital upon it, which is reducing the ability to create more capacity. And I think that could come to gold. I wonder how many ESG portfolios are going to have gold shares in them in 3, 4, 5 years from now? How many bankers are going to lend to gold miners? So perversely, that's a form of attack on gold, which is actually very good for the gold price, but it's going to cause some trouble for miners. So that makes me positive on gold rather than negative on gold. I think gold is just not that important in the financial system that the government has to go after it for financial reasons. Mm-hmm. We might find ourselves going after it for ecological reasons.
Well, Russell, that what you just described fits perfectly with something that a very, very well-known institutional asset manager from London actually told me. He said that lots of capital is being directed from, you know, or let's say that many gold mining companies are kind of being pushed into the direction of green metals, especially copper, because this is where institutional investors, due to all the ESG rules that are coming up, have to invest. Now, I don't think that many of those people have ever visited a mine, and not a gold mine, and especially not a copper mine. So I would question if copper mines are much greener than gold mines. But I really could see that coming, that, you know, also large gold mining companies will continue to make acquisitions in the copper space and in other, let's say, green metals. But we have to come to an end, unfortunately. I think there's many topics that we could still discuss. I wanted to discuss the deflationary impact of artificial intelligence. I think at some point we'll just tell ChatGPT, write the next Solid Ground newsletter or write the next In Gold We Trust. But one thing, and this is a really I loved our brief conversation that we had via email, because yesterday I sent you a quick email saying, well, we're gonna discuss those topics, and here's the link. And then I was kidding, and I said I would also love to discuss the fact why my team, Rapid Wien, has just lost the cup finals versus Sturm Graz. And you got back to me and said, Rapid Wien has the problem that always makes the difference, not enough money. And then you were linking to an FT article that basically said, Italy at odds with Brussels over using EU money for football stadium. So you wrote, well, actually, you know, fiscal stimulus is also impacting the football market. And when credit is politicized, everything is possible. So the solution for my problem as a Rapid Wien supporter would probably be that the Austrian government would have to step in, right?
Well, I mean, the Austrian government needs to go to see Christine Lagarde, explain why they need a large loan and why it's essential for the health of the whole of Vienna that the stadium is rejuvenated. It's working for the people of Florence, so why not? She can only say no, and she might say yes.
The problem is we just got a new stadium.
Find something else. Underground car parks are very useful as well.
Well, Russell, thank you very much for taking the time again. Thank you for being such a great supporter, for being also to some sort of a mentor. I've read your books. I attended your course. I loved it. Not only, you know, the teaching, but also, you know, exchanging with the other people in the course. We're very happy subscribers of your Solid Ground newsletter, and thank you very much for taking the time. If there's something that you want to say at the end.
Well, I should just put a quick plug in for that course to say that as I was locked down here for nearly 2 years, I created an online version of that. I mean, not just me, all of the teachers. So if anybody can't make it to London for our 2 sessions per annum, then go to the Library of Mistakes website, actually, and you'll find a link on the Library of Mistakes website that will take you to the online version of the course. So, and then you can help us. It's all run by a charity, and we very, I think, arrogantly, our motto is changing the world one mistake at a time. So, Ronnie, I hope we've done a little bit of that today. And the problem is it'll take us years to find out.
I'm sure there's a bull market of mistakes out there. And I think to sum up our conversation and what your view basically is, I would say it's a little bit like save like a pessimist, but invest like an optimist. I think that's what really sums it up pretty well. So Russell, thank you very much for taking the time. Niko, thank you for taking the time. Thank you for being so supportive when it comes to the In Gold We Trust and everything around. And I wish you two gentlemen all the best. And Russell, I'll hopefully see you in Vienna very soon.
I hope so. Niko, Ronnie, thanks very much.
Thank you both.
Thank you. Bye-bye.